Hello students, welcome to APG Patsala. I am Dr. Sanjeev Sharma from Government College Nadon, Himachal Pradesh. Today we are going to talk on module financial statements, meaning, nature, types of financial statements from paper, accounting and financial analysis. After studying this module, students may able to gain clarity on financial statements and assist in decision making. In addition to this, financial statements are the source of information on the basis of which conclusions are drawn about profitability, financial position of a concern, on the basis of which decisions are taken. The students will also able to understand the general guidelines in preparing the financial statements, which is useful for investors, creditors, owners and general public. Accounting is the process of identifying, measuring, communicating economic information to permit informed judgment and decisions by user of the information. It involves recording, classifying and summarizing various business transactions. The end product of business transactions are financial statements comprising primarily the position statement and balance sheet and the income statement or the profit and loss account.
Present figure shows that accounting is the process. It is the process and end product of this process is financial statements. Accounting is the process and various steps in this process are passing journal entries or recording, then classifying, that means preparing ledger accounts, and summarizing. An end product of this whole process of accounting, or the final product or the output of this process, is financial statements. Now, financial statements mean profit and loss account, that is profitability statement or income statement, and balance sheet, that is position statement. And with the help of these statements, financial position and profitability of an business can be assessed.
These statements are outcome of summarizing process of accounting and are therefore the source of information on the basis of which conclusions are drawn about the profitability and financial position of the concern. Financial statements are the basis for decision making by the management as well as other outsiders who are interested in affairs of the business, such as investors, creditors, customers, suppliers, financial institutions, employees, potential investors, government, general public. The analysis and interpretation of financial statements depends upon the nature and the type of information which is available in these statements. Now, objectives of the financial statements. Why these statements are prepared? Why such importance is given to financial statements? The financial statements are the source of information on the basis of which conclusions are drawn about the profitability and financial position of a concern. They are major means employed by the firm to present financial situation to owners, creditors and to general public. The primary objective of financial statement is to assist in decision making. The Accounting Principal Board of America states the following objectives of the financial statements.
Now, why financial statements are prepared? Now, what is the objective of preparing financial statements? The financial statements are prepared to provide reliable financial information about the changes in economic resources and obligations of a business firm. Economic sources mean assets and obligations mean equity and liabilities. So with the help of financial statement, we can get the knowledge of the changes which are taking place in assets or liabilities of a business. Further, these provide other needed information about the changes in such economic resources and obligations. These provide reliable information about changes in net resources and obligation of a business activities. These are prepared to provide financial information that assists in estimating the earning potential of the business. With the help of these financial statements, we can estimate the future earning potentials of the business. Further, these are prepared to disclose to the extent possible other information related to the financial statements that is relevant to the needs of the users of these statements.
Now, what is the meaning of financial statements? Financial statements are the depiction of the financial position of a firm. The financial statements are prepared by the business firm. Thus, the term financial statements generally refers to two statements. One, position statement or balance sheet. The second is income statement or profit and loss account. These statements are prepared by the business firm. These are prepared with the objective to communicate with different parties about the financial position of the business firm. These parties include user of the financial informations like shareholders, creditors, banks, financial institutions, financial analysts, investors, and government. Further, these are prepared to analyze the operations and performance of the business firm for further planning.
The financial statements communicate with different parties. These are helpful in analyzing the operations and performance of the firm. So these are very important, and it is disclosed in this figure that the business can communicate with different parties. The parties involve investors, shareholders, employees, management, government, and the organization or business can communicate with these parties with the help of financial statements. Now, everybody is interested in analyzing the operations and performance of the business, and this performance can be analyzed with the help of these financial statements. According to a method of certified public accounts, financial statements are prepared for the purpose of presenting a periodical review or report by the management and deal with the status of the investment in the business and the result achieved during the period under review.
The nature of financial statements. The financial statements are prepared on the basis of recorded facts. These facts, the recorded facts, are those which can be expressed in monetary terms. The financial statements by nature are summaries of the items recorded in business, and these statements are prepared periodically, generally for an accounting period. The following points explain the nature of financial statements.
Nature of financial statement is revealed in the figure. Figure reveals that financial statements are the recorded facts. These are based upon accounting conventions, postulates, and personal judgments of the accountants. Simply, financial statements are recorded facts. Further, these are prepared according to personal judgments of the accountants, and these can vary from accountant to accountant. While preparing the financial statements or while recording the transactions in financial statements, some accounting conventions and postulates are followed, and these statements are prepared on the basis of these assumptions.
Recorded facts. The term recorded facts refers to the data taken from accounting records. The records are maintained on the basis of actual cost data. The original cost or historical cost is the basis of recording various transactions. The figures in various accounts such as cash in hand, cash at bank, bills receivable, sundry debtor, fixed assets, etc. as per the figures recorded in the accounting books. Accounting conventions. Certain accounting conventions are followed while preparing the financial statements. The convention of valuing inventory at cost or market price, whichever is lower, is followed. The valuing of assets at cost less depreciation principle for balance sheet purpose is followed. The convention of materiality is followed in dealing with small items like pencil, pen, postage stamps, etc.
Postulates. The accountant makes certain assumptions while making accounting records. One of these assumptions is that the enterprise is treated as a going concern. The other alternative to this postulate is that the concern is to be liquidated. This is untenable if management shows an intention to liquidate the concern. So assets are shown on a going concern basis. Another important assumption is to presume that the value of money will remain the same in different periods. So there is a drastic change in purchasing power of money. The assets purchased at different times will be shown at the amount paid for them. So simply financial statements are based upon certain assumptions, and these are the basis upon which these statements are prepared. Personal judgment. Even though certain standard accounting conventions are followed in preparing financial statements, but still personal judgments of the accountants plays an important part. For example, in applying the cost or market value, whichever is less, to inventory valuation, the accountant will have to use his judgment in computing the cost in a particular case. There are a number of methods which are used for valuing stock, such as LIFO, that is last in first out method, FIFO, first in first out method, average cost method, standard cost method, base stock method. All these methods are used for calculating value of stock, and accountant will have to use his judgment in computing the cost in a particular case.
Let us discuss the types of financial statements. What are different types of financial statements? Financial statements primarily comprise of two basic statements. First is position statement or balance sheet, and second is income statement or profit and loss account. However, a complete set of financial statements must include a balance sheet, an income statement, a statement of changes in financial position, statement of changes in equity.
There are different types of financial statements, and types of financial statements mainly include a balance sheet, an income statement, a statement of changes in financial position, a statement of changes in equity if applicable. These are the financial statements which should be used by and concerned, and this figure reveals that the financial statements include balance sheet, that is position statement, income statement, that is profit and loss account, statement of changes in financial position, which include cash flow statement or fund flow statement, and statement of changes in equity if applicable.
Now, what is the meaning of balance sheet? The balance sheet is one of the important statements depict the screen picture of financial position of a going business at certain moment. It shows on the one hand the properties that it utilizes, and on the other hand the sources of those properties or assets. The balance sheet shows all assets owned by the concerned and all the liabilities or claim it owes to owners and outsiders. The balance sheet is prepared on a particular date. The right hand side shows properties and assets.
Balance sheet. There is no specific form for preparation of balance sheet in case of sole trade or partnership firm. There is not a particular format according to which balance sheet is needed to be prepared in these organizations. Balance sheet is a statement of assets, liabilities, and capital of an organization. Table 1 presents the pro forma of balance sheet of a company as per old schedule of Indian Companies Act 1956. Earlier horizontal form of balance sheet, and according to this horizontal form of balance sheet, liabilities and assets are shown, and there were different heads such as share capital, reserve and surplus, debentures, current liabilities, provisions. On the asset side, all fixed asset less depreciation, investment, all current assets, loans and advances, and miscellaneous expenses were shown. Vertical form of balance sheet is shown in this present slide, and it shows that the balance sheet is divided into two parts. First is sources of funds, and second is application of funds. Sources of funds is related with liabilities and equities, that is shareholder fund, loan funds. Shareholder fund include capital and reserve and surplus. Loan fund includes secured loan and unsecured loan. Whereas application of fund is related with using that money, that is sources of funds, for the purpose of purchasing fixed assets, current assets, and loan and advances, miscellaneous expenses. So these are shown in the application of money. The explanation of various items of balance sheet. The share capital. Share capital is shown as a first item on the liability side of the balance sheet. Authorized and issued capital is shown giving the number of shares and their amount. The number of shares for which public has applied are mentioned along with the type of capital, that is preference share capital, equity share capital. If capital is issued for other than cash, the amount of such capital is mentioned. Reserve and surplus. Under this heading, all those reserves which have been created out of undistributed profit are shown. Capital reserves are classified as capital reserve and revenue reserve. Capital reserve are those reserves which are not free for distribution of profits, whereas revenue reserves are created out of appropriation of profits. The reserves include capital reserve, capital redemption reserve, share premium account, other reserve, and surplus. Secured loan. All those loans against which securities are given are shown under this category. Debenture are shown under this heading. Loans and advances, banks, subsidiary companies should also be mentioned. Unsecured loan. These are the loans and advances against which the company has not given any security. The items included here are deposits, loans, advances from subsidiary companies, loans and advances from subsidiary companies from other sources. Short-term loans include those loans which are due for not more than 1 year on the date of balance sheet. As regards loan from directors, managers, these should be shown separately under different subheadings. Current liabilities and provisions. Current liabilities include acceptance, sundry creditors, subsidiary companies, advances payments, unexpired discounts, unclaimed dividends, other liabilities, etc. Provisions include provision for depreciation, proposed dividends, provision for contingencies, provision for dividend scheme, and other provisions. The items of balance sheet asset side. Fixed asset. Fixed assets are those which are purchased for use over a long period. These assets are meant to increase production capacity of the business. They are not acquired for sale but are used for considerable period of time. The balance sheet is prepared and depicts the true financial position of the business. Fixed assets are shown distinctly from other, that is goodwill, land and building, leaseholds, plant and machinery. Investments. Investments are shown by giving their nature and mode of valuation. Investments under subheads such as investment in government or trust securities, in shares, debentures, bonds, in movable properties are given separately in the inner column of the balance sheet. Current assets. Current assets are such assets as in the ordinary and natural course of business move onward through the various processes of production, distribution, and payment of goods until they become cash or its equivalent by which debts may readily and immediately paid. Miscellaneous expenses. We show deferred expenditure under this heading. These are the expenses which are not debited fully to the profit and loss account for the year which they have been incurred. These expenses are spread over a number of years and the unwritten amount of balance is shown in the balance sheet. Presently, as per Schedule 3 of the Companies Act 2013, balance sheet is prepared by the companies. Balance sheet as per Schedule 3 of the Companies Act 2013 applicable for the financial year commencing on or after 1st April 2011 is given here, and according to this the balance sheet is divided into two parts. The first is equity and liabilities. The amounts of previous year and current year are to be disclosed. The equity and liability is divided into four parts or heads. The first is shareholder fund. Second is share application money pending allotment. Third is non-current liabilities. Fourth is current liabilities. Shareholder fund includes share capital, reserve and surplus, money received against share warrants. Non-current liabilities include long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions. Current liability include short-term borrowings, trade payables, other current liabilities, short-term provisions. These are the items which should be shown on the equity and liabilities, and it should be remembered that all these items as per Schedule 3 to the Companies Act 2013 should be disclosed in the balance sheet in the financial year which are commencing on or after 1st April 2011. Assets are shown here. Assets are divided into two subheads: non-current assets and current assets. Non-current assets include fixed assets, non-current investments, deferred tax assets, long-term loans and advances, other non-current assets. Fixed assets comprise of tangible assets, intangible assets, work in progress, intangible assets under development, non-current assets, deferred tax, and current assets include current investments, inventories, trade receivable, cash and cash equivalents, short-term loans and advances, other current assets. So, assets should be disclosed in this way while preparing balance sheet of a company.
Income statement or profit and loss account. Income statement is prepared to determine the operational position of the concern. It is the statement of revenues earned and expenses incurred for earning the revenues. If there is excess of revenue over the expenditure, it will show profit. And if expenditure are more than income, then there will be losses. The income statement is prepared for the particular period, generally a year. The income statement is prepared for the year ending on 31st December 2015, then all revenues and expenditure falling due in that year will be taken into account irrespective of receipt or payment.
Income statement is prepared according to the nature of the business. A trading concern will prepare trading and profit and loss account for finding out gross profit or net profit respectively. In the case of sole proprietorship or partnership concern, there are no prescribed forms for income statement. The preparation of this statement is not compulsory but desirable. But in case of company, it is compulsory to make income statement. The format of a manufacturing account is given here, and with the help of this manufacturing account, the cost of finished goods is transferred to trading account. All expenses are shown on the debit side. It is clear from this account. Trading and profit and loss account is given here. All expenses such as purchases are shown on the debit side, whereas sale is shown on the credit side. but the indirect expenses are also shown on the debit side, and all indirect incomes are shown on the credit side. And with the help of this account, after preparing trading account, gross profit is or loss is determined, and after preparing profit and loss account, net profit or net loss is assessed. Presently, Part 3 of the Schedule of the Companies Act 2013 provide the format of general instructions for preparation of a statement of a profit and loss. Statement of profit and loss as per Schedule 3rd of the Companies Act 2013 applicable for the financial year commencing on or after 1st April 2011 is given, and this statement is started with revenue from operation, then other incomes are added in this revenue from operation, and total income is determined, and after deducting the expenses from this income, profit is assessed. This slide shows the expenses and profit which is determined with the help of comparing expenses and income. In this slide, the profit and earning per shares are shown. Profit and loss appropriation account. Joint stock companies prepare profit and loss appropriation account. This is also known as retained earning account. This account is prepared to show the profit of the company have been used for apportioned, and the form of this account is given. The form of profit and loss appropriation account is given here. The balance of last year and current year profit is shown on the credit side, whereas transfer to reserve, transfer to sinking fund, dividend are shown on the credit side. The statement of changes in financial position can be divided into two parts. One is fund flow statement, second is cash flow statement, and it is clear from this figure. The statement of changes in financial position. Fund flow statement. The fund flow statement is designed to analyze the changes in the financial position of a business between two periods. The word fund is used to denote working capital. This statement will show the sources from which the funds are received and uses to which these have been put. This statement helps the management in policy formulation and performance appraisal. And the second statement of changes in financial position is cash flow statement. A statement of changes in financial position of a firm on cash basis is called cash flow statement. It summarizes the causes of changes in cash position of a business enterprise between dates of two balance sheets. This statement is very much important. Statement of changes in equity. Financial statement as per section 2 subsection 40 includes statement of changes in equity. It has been taken from International Financial Reporting Standards. As per International Accounting Standard 1, the preparation of statement of changes in equity is required. However, neither any form for statement nor any definition or explanation regarding the same is available under Schedule 3rd of the Act.
So students, let us now summarize what we have learnt in this module. Financial statements are the basis for decision making by the management as well as other outsiders who are interested in the affairs of the firm, such as investors, creditors, customers, suppliers, financial institutions, employees, potential investors, government, and general public. The analysis and interpretation of financial statement depends upon the nature and type of information available in these statements. The financial statements by nature are the summaries of the items recorded in business, and these statements are prepared periodically, generally for accounting period. The financial statements primarily comprise of two statements. First is position statement or balance sheet, and second is income statement or profit and loss account. Income statement is prepared to determine operational position of the concern. It is the statement of revenue earned and expenses incurred for earning that revenue. If there is excess of revenue over expenditure, it will show the profit, and if expenditure are more than the income, then there will be loss. A statement of retained earning is also known as profit and loss account. or profit and loss appropriation account or income disposal statement, as the name suggests, it shows appropriation of earnings. The statement of changes in financial position refers to as cash flow statement, provides information about flow of cash during a particular period. It also provides information about financial and investing activities of a firm.